Good evening. I'm your host, and this is Kenya News Update today. We begin with a developing global economic crisis that's sending shockwaves through markets worldwide. Gas and oil prices have soared to multi-year highs, while stock markets from New York to Nairobi are tumbling. The trigger? Fears that a conflict in the Middle East could escalate dramatically, threatening global energy supplies and economic stability. Tonight, we take a deep dive into the numbers, the causes, and what this means for you. We'll examine the spike in energy costs, the market panic, and the potential ripple effects on inflation and everyday life. We'll also explore the geopolitical tensions at the heart of this crisis and hear from analysts on whether this is a temporary shock or the start of a prolonged downturn. Over the next 12 minutes, we'll break down the complex interplay of war, energy, and finance. First, let's look at the immediate market reaction that has investors and governments on high alert. The UK gas price surged to its highest level in 3 years on Tuesday, following sharp gains on Monday. Meanwhile, the global benchmark for oil, Brent crude, briefly rose above $85 a barrel for the first time since July 2024. That's a significant psychological and economic threshold. In the United States, the Dow Jones Industrial Average fell by over 400 points, a drop of more than 1.23%. European markets fared even worse, with Germany's DAX index down 2.75% and France's CAC 40 falling 3.44%. In Asia, Japan's Nikkei closed down 3.46%. The fear is palpable and widespread. But why this sudden, synchronized panic? The answer lies in a specific and volatile region. The conflict in the Middle East has intensified over recent days, with direct attacks on shipping lanes and key energy infrastructure. Analysts are no longer asking if the conflict will impact oil flows, but how severely and for how long. A key choke point, the Strait of Hormuz, through which about 20% of the world's seaborne oil passes, is now seen as a potential flashpoint. Any disruption there could immediately remove millions of barrels per day from the market. This isn't just about today's headlines. It's about the market's forward-looking anxiety over supply security for the next quarter, the next year. The price spike reflects a risk premium that investors are adding to every barrel of oil, anticipating worse to come. Let's visualize the initial shock to the system. The UK gas price surged to its highest level for 3 years on Tuesday, following sharp gains on Monday, while Brent crude oil benchmark briefly rose above $85 a barrel. This dual surge in energy commodities is the core of the crisis. Now, let's add the stock market reaction to the picture. The sell-off wasn't confined to any one sector. Airlines, heavily dependent on jet fuel, were hit hard, with some European carriers seeing shares fall by over 7%. Cruise lines and transportation companies followed suit. Even technology stocks, often seen as somewhat insulated from oil prices, fell sharply as investors fled riskier assets altogether. The bond market told a parallel story of fear. Investors rushed into the perceived safety of government bonds, pushing yields lower. The yield on the 10-year U.S. Treasury note, a global benchmark for borrowing costs, fell to 3.3%. This flight to safety is a classic sign of market stress, where capital preservation becomes the priority over growth. The economic calculus is straightforward but brutal. Higher energy costs act as a tax on consumers and a drag on corporate profits. For the average household, a sustained oil price above $85 a barrel translates directly to more expensive petrol, heating, and electricity bills. For businesses, it means higher operating costs, which can lead to lower investment, hiring freezes, or price increases passed on to customers. This is the dreaded stagflation scenario, slowing growth coupled with rising prices. Central banks, including the Federal Reserve and the European Central Bank, now face a nightmare dilemma. Do they continue fighting inflation, potentially worsened by these energy prices, by keeping interest rates high or even raising them? Or do they pivot to support growth, risking an inflation spiral? Their next moves are being scrutinized like never before. Let's quantify the potential impact on a global scale. Analysts estimate that every sustained $10 increase in the oil price could shave 0.2% off global GDP growth. At $85, we are already in a danger zone for the economic recovery. But the story has more layers. Let's shift perspective and examine the situation from the ground in the conflict zone and from the boardrooms of energy companies. For energy producers, this price spike is a windfall. Companies in the Permian Basin in Texas, the North Sea, and elsewhere are seeing their revenue projections soar. Shares of major oil companies like ExxonMobil and Shell initially bucked the market trend, rising on the news. However, that gain was short-lived as broader market panic set in. The reason? Uncertainty. Even producers fear an uncontrolled escalation that could lead to a full-blown regional war, damaging infrastructure and creating chaos that hurts everyone. Furthermore, these companies are under immense political and social pressure, not to be seen as profiteering from war. They must balance shareholder returns with public perception. Meanwhile, in the Middle East, the calculus is different. For some regional powers, higher oil prices bolster national budgets and geopolitical leverage. It provides more resources for military spending and domestic subsidies to maintain stability. This creates a perverse incentive. Prolonged tension without all-out war can be financially beneficial for oil-exporting nations, making diplomatic solutions more complex. This brings us to the heart of the debate. Is this a speculative bubble or a fundamental shift? One school of thought, led by market bulls and some geopolitical analysts, argues this is an overreaction. They point to significant strategic petroleum reserves held by the U.S. and its allies, which could be released to calm markets. They also note that global oil demand growth is slowing, and alternative energy sources are making gradual inroads. The conflict, they argue, will likely remain contained, and prices will retreat once the initial fear subsides. The other, more pessimistic view comes from security experts and veteran oil traders. They argue the geopolitical landscape has fundamentally fractured. The era of reliable, cheap energy from the Middle East is over, they say. The conflict has exposed the fragility of just-in-time global supply chains. Even if a ceasefire is brokered tomorrow, the trust is broken. The risk premium, they contend, is now a permanent feature of the market. Investors will demand higher returns for the increased political risk, keeping a floor under prices. This view suggests we are witnessing a structural repricing of energy, not a temporary blip. The data from the futures market supports the nervous outlook. The forward curve for Brent crude shows prices remaining elevated well into 2027, indicating traders are pricing in long-term disruption. Now, let's bring this global story closer to home. What does a world of expensive oil mean for Kenya and East Africa? The effects are both direct and indirect. Directly, Kenya imports all of its refined petroleum products. A higher global price means a higher import bill, which puts pressure on the Kenyan shilling as more dollars are needed to pay for fuel. This can lead to depreciation, which makes all other imports more expensive, from machinery to medicine. The Energy and Petroleum Regulatory Authority will face intense pressure regarding fuel price reviews. The government subsidy program, if any exists, would be tested severely. Indirectly, Kenya's economy is vulnerable through two key channels: tourism and agriculture. Higher jet fuel prices mean more expensive airfares, which could deter tourists during a crucial recovery period for the sector. For agriculture, which is the backbone of the economy, the cost of fertilizers, often tied to natural gas prices, and diesel for tractors and transport will rise. This increases the cost of production for tea, coffee, and horticulture, making Kenyan exports less competitive on the global market. Furthermore, remittances from the diaspora, a critical source of foreign exchange, could weaken if the global economic slowdown affects jobs in Europe and North America. The Central Bank of Kenya will have to navigate these treacherous waters, balancing inflation control with support for economic growth. President William Ruto's administration will be watching these developments closely, as energy costs are a direct political hot-button issue. Let's examine the potential budget impact. A sustained price of $85 oil could add 500 million shillings per month to Kenya's national import bill, straining foreign reserves. So, what can be done? On the global stage, diplomacy is the first and most important tool. The United States, under President Donald Trump, along with European and regional powers, is likely engaged in intense behind-the-scenes efforts to de-escalate the conflict. The goal is to secure a ceasefire and open channels for dialogue to address the root causes of the tension. The success or failure of these efforts will be the single biggest determinant of where oil prices go next. Secondly, there is the strategic reserve option. The International Energy Agency could coordinate a release of stocks to demonstrate a united front and signal to markets that consumer nations will not be held hostage. This has worked to moderate prices in the past, but its effectiveness depends on the scale of the physical disruption, if any occurs. For individual countries and companies, the response is about resilience and diversification. This crisis is a stark reminder of the economic risks of over-reliance on a single geographic region for a critical resource. It will accelerate investments in renewable energy, not just for environmental reasons, but for energy security. Solar, wind, and geothermal become more attractive not only on cost but on predictability. For Kenya, With its significant geothermal potential, this underscores the strategic importance of the energy transition. It also highlights the need for regional infrastructure, like the refined products pipeline, to improve efficiency and reduce costs. On a personal level, consumers are advised to brace for higher costs in the short term. Budgeting for increased transport and utility expenses is prudent. However, knee-jerk reactions like panic buying fuel are counterproductive and can exacerbate local shortages. The key is to stay informed through reliable sources and avoid speculation. As we conclude this deep dive, the overarching message is one of profound uncertainty. The global economy, still finding its footing, has been thrown back into the fog of geopolitical risk. The numbers, $85 oil, tumbling share prices, spiking gas costs, are symptoms of a deeper anxiety about the stability of our interconnected world. The path forward hinges on decisions made in war rooms and boardrooms far away, but their consequences will be felt at petrol stations and in monthly bills right here. The next few weeks will be critical. Will diplomacy prevail, allowing markets to breathe a sigh of relief? Or will escalation lock in a new, more expensive era for global energy? We will be following every development closely. For now, the advice from economists is to prepare for volatility, hope for peace, and recognize that in our globalized world, a conflict thousands of miles away can ripple through every facet of our economic lives. Thank you for watching. Subscribe to Kenya News Update today for continuing coverage of this and other vital stories.